The year is 2006. Wall Street is printing money. Housing prices are soaring 20% year over year. Mortgage-backed securities are the hottest investment on the planet. And everyone, from the biggest banks to the smallest investors, believes they've found the ultimate money machine. But here's the thing about money machines. They don't exist. And when enough people believe in something that's too good to be true, the crash isn't just inevitable, it's catastrophic. This is the story of how investors ignored every single warning before the 2008 financial crisis. Not because they didn't see them, but because they chose not to believe them. Act 1. The perfect storm brewing. To understand how we missed the warnings, we need to go back to where it all began, September 11th, 2001. In the aftermath of the terrorist attacks, the Federal Reserve, led by Chairman Alan Greenspan, slashed interest rates to historic lows, down to just 1%. The goal was noble: prevent a recession, keep the economy moving. But those low rates created something else entirely, a tidal wave of cheap money flooding into the market, looking for returns. And it found those returns in housing. Why keep your money in savings accounts earning 1% when you could buy a house that was appreciating 15, 20, even 30% per year? Real estate became the national obsession. From California to Florida, housing prices defied gravity. Everyone became a real estate mogul. Taxi drivers owned 5 investment properties. Teachers were flipping condos. The assumption was simple and seductive. Housing prices never go down. Not really. Not nationally. Not all at once. Warning sign number 1 appeared in 2003, but almost nobody noticed it. The ratio of home prices to household income began breaking every historical record. For decades, this ratio had remained stable. Homes typically cost about 3 to 4 times the average household income. By 2003, that ratio was climbing past 5. By 2006, it would reach 7 in some markets. Economists at the Federal Reserve quietly published papers about it. The Bank for International Settlements issued warnings. Dean Baker, an economist at the Center for Economic and Policy Research, literally called it the housing bubble fact sheet in 2005. But Wall Street had an answer for everything. This time is different, they said. We have better financial models, better risk management. We've securitized the risk. That word, securitization, would become the most expensive word in financial history.
Act 2. The machine that ate Wall Street. Here's how the machine worked. In the old days, when you got a mortgage, your local bank kept that loan on their books. If you defaulted, they lost money. So they were careful about who they lent to. But in the 2000s, Wall Street invented a better mousetrap, or so they thought. Banks would originate mortgages, then immediately sell them to investment banks. Those investment banks would bundle thousands of mortgages together, slice them into pieces called tranches, and sell them to investors as mortgage-backed securities. The incentives had completely flipped. The bank originating your mortgage didn't care if you could pay it back. They were selling it immediately. The investment bank packaging it didn't care either. They were selling it to pension funds and hedge funds. And those end investors? They were told these securities were safe, AAA rated, as solid as U.S. Treasury bonds. Warning sign number 2 should have been impossible to miss. By 2005, lending standards had completely collapsed. Ninja loans, no income, no job, no assets, were being approved by the thousands. Stated income loans, where borrowers just wrote down whatever income they wanted with no verification. Adjustable rate mortgages with teaser rates that would balloon after 2 years. Interest-only loans. Negative amortization loans where your debt grew every month even as you made payments. A migrant strawberry picker in California was given a $724,000 loan to buy a house. Unemployed individuals were getting approved for million-dollar mortgages. Mortgage brokers were paid on commission and had zero liability for defaults. The worse the loan terms, the higher their commission. Some borrowers were coached to lie on applications. Others were steered toward the most predatory loans available, even when they qualified for better terms. But here's the insane part. When these garbage loans were packaged into securities, the rating agencies, Moody's, Standard & Poor's, and Fitch, gave them AAA ratings, the same rating as U.S. government debt. Why? Because the banks creating these securities were paying the rating agencies to rate them. It was like students paying their teachers for grades. The agencies that gave the best ratings won the most business. Some analysts at rating agencies raised concerns. They were ignored or pushed out. One S&P analyst wrote in an internal email, "Let's hope we are all wealthy and retired by the time this house of cards falters." They knew. They absolutely knew.
Act 3. The Prophets in the Wilderness. But not everyone was blind. A handful of investors saw exactly what was coming and tried to sound the alarm. Warning sign number 3 came from the people actually reading the mortgages. Steve Eisman, a portfolio manager at Front Point Partners, started investigating mortgage-backed securities in detail. What he found horrified him. He attended a conference in Las Vegas where mortgage originators openly bragged about the loans they were making. He realized the entire industry was either delusional or fraudulent. Michael Burry, a physician turned hedge fund manager, spent his time reading hundreds of mortgage prospectuses, the actual underlying loans in these securities. He discovered that the loans were deteriorating in quality month after month, but the securities' ratings weren't changing. He realized that when these adjustable-rate mortgages reset to higher rates in 2007, there would be a wave of defaults like nothing in American history. Burry did something radical. He asked Goldman Sachs and other banks to create a product that would let him bet against the housing market: credit default swaps on mortgage-backed securities. Essentially insurance policies that would pay out when these securities failed. The banks thought he was insane. They happily sold him these swaps, convinced they were taking his money. Some banks were so confident that they bought the other side of his bet with their own capital. Others tried to warn the public. In 2005, David Rosenberg, chief economist at Merrill Lynch, began warning clients about the housing bubble. He was sidelined. In 2006, Nouriel Roubini predicted the crisis in a presentation to the International Monetary Fund. He was mocked as Dr. Doom. CNBC and financial media ridiculed the pessimists. Jim Cramer, the popular TV host, famously said in July 2005, "You're nuts not to be buying. Get out of bonds, get into housing." Ben Bernanke,
who became Fed chairman in 2006, testified to Congress that there was no housing bubble, and that even if there were, it wouldn't significantly impact the broader economy. The warnings were there, loud and clear, but they were drowned out by the money machine's roar.
Act 4. The bubble peaks. By 2006, the housing market had reached levels of pure absurdity. In some California markets, the median home price was 12 times the median income. 40% of new mortgages were interest-only or negative amortization. Housing prices in Las Vegas had increased 170% in just 5 years. Warning sign number 4 was staring everyone in the face. Housing inventory began to surge. Prices stopped rising in many markets. Then they started falling. Defaults on subprime mortgages began ticking up. Not catastrophically, just enough to notice if you were paying attention. The response from Wall Street? It's contained. That became the mantra. In March 2007, Bernanke testified, "The impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained." Contained. That word would age like milk in the sun. In April 2007, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. The stock market shrugged. A few weeks later, Bear Stearns announced that 2 of its hedge funds, heavily invested in subprime mortgages, were in trouble. The market dipped, then recovered. Warning sign number 5 came in August 2007. BNP Paribas, a major French bank, froze withdrawals from 3 investment funds, citing their inability to value assets because of problems in the U.S. subprime market. This was a 5-alarm fire. If banks couldn't even determine what their mortgage securities were worth, the entire pricing mechanism of the market had broken down. The Federal Reserve responded by cutting interest rates and pumping liquidity into the market. But it was like trying to fix a dam with duct tape. The cracks were spreading. Still, most investors stayed in. They'd been making money for years. This was just a correction, they told themselves, a buying opportunity. Housing prices couldn't fall that far. The securities were diversified across the whole country. What were the odds that housing would crash everywhere at once? Act 5. The collapse. The answer was 100%. Because when you build an entire financial system on garbage loans, diversification doesn't protect you, it just spreads the infection everywhere. By early 2008, housing prices were in free fall. Foreclosures were exploding. Those adjustable rate mortgages that Michael Burry had studied were resetting, and homeowners couldn't afford the new payments. They couldn't refinance because their homes were now worth less than their mortgages. They couldn't sell for the same reason. The only option was default. March 2008, Bear Stearns, an 85-year-old investment bank, collapsed in a matter of days. It was sold to J.P. Morgan Chase for $2 per share in a government-facilitated fire sale. The stock had been trading at $170 per share a year earlier. The contagion was spreading. Every major bank had exposure to these toxic securities. Nobody knew how much because the securities were so complex and the accounting was so opaque that not even the banks themselves knew what they owned. September 15, 2008, Lehman Brothers, one of the most prestigious names on Wall Street, filed for bankruptcy. The U.S. government, trying to draw a line against moral hazard, refused to bail them out. It was the wrong line to draw. Lehman's bankruptcy triggered a global panic. The commercial paper market, the short-term lending that keeps businesses running, froze. Money market funds, considered as safe as bank accounts, were breaking the buck, losing value. Credit markets seized up completely. Banks stopped lending to each other because nobody knew who was solvent and who was hours from collapse. The stock market went into free fall.
On September 29th, the Dow Jones dropped 777 points in a single day, the largest point drop in history at that time. Trillions of dollars in wealth evaporated. AIG, the world's largest insurance company, had insured hundreds of billions in mortgage-backed securities through credit default swaps. When those securities failed, AIG owed money it didn't have. The government bailed it out with $182 billion of taxpayer money. Banks around the world either collapsed or required massive government bailouts. Washington Mutual, Waccochia, Royal Bank of Scotland. The list went on and on. The crisis jumped from Wall Street to Main Street. 9 million Americans lost their jobs. 6 million lost their homes to foreclosure. Retirement accounts were decimated. The total cost to the global economy was estimated at over $22 trillion.
Act 6. The Aftermath and the Lesson Unlearned. In the years after the crash, the investigations began. Congressional hearings, criminal probes, books and movies documenting the disaster. What they revealed was stunning, but not surprising. Banks had knowingly sold garbage securities to their own clients while betting against them. Rating agencies had given AAA ratings to securities they knew were junk. Regulators had been captured by the industry they were supposed to regulate. Fraud was rampant at every level. But here's the part that should terrify you. Almost nobody went to jail. A handful of low-level mortgage brokers were prosecuted, one mid-level Credit Suisse banker. But the executives who ran the banks that caused the crisis, they walked away. The banks that were too big to fail became even bigger after the crisis, swallowing up the smaller banks that collapsed. The government bailouts, justified as necessary to save the economy, ensured that the people who caused the crisis paid no real price for their recklessness. Closing. Why they ignored the warnings. So why did investors ignore every warning? Why did they stay in the market, even as the signs of disaster multiplied? It wasn't just greed, though greed played a role. It was something more fundamental. Incentive structures that rewarded short-term profits over long-term stability. Traders made millions each year and didn't care if the bank collapsed 3 years later. They'd already been paid. CEOs with massive stock option packages cared about this quarter's earnings, not next decade's sustainability. It was also the belief that the system was too big to fail, that the government would always step in. That belief, as it turned out, was correct, which is why we never truly fixed the underlying problems. But perhaps the most important reason is this. When everyone around you is making money, when the experts are telling you everything is fine, when questioning the narrative means being left behind while others get rich, it takes extraordinary courage to believe the warnings. The 2008 crisis taught us that markets are not rational, that the crowd is not wise, that the emperor often has no clothes, but everyone is too invested in the illusion to point it out. The warnings were there, every single one of them. In the data, in the mortgage files, in the economic ratios, in the voices of the contrarians screaming into the void. They were ignored, not because they were wrong, but because believing them was too expensive, until ignoring them became even more expensive. The question we should be asking isn't, how did we miss the warning signs? We didn't miss them. We saw them clearly.
The question is, what warning signs are we ignoring right now? Because history doesn't repeat itself, but it rhymes. And somewhere, right now, someone is sounding an alarm that everyone else is choosing not to hear. The only question is, will you be one of the ones listening?